This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our previous lecture together on partnership, we saw how it was that if a new partner joined a partnership, then so far as that new partner was concerned, it was a new business. So the date they joined the partnership represents their start date of a new trade. And that meant that we had to establish the profits, again, in the normal way, using the profit sharing agreement during the accounting period. And having established his or her profits from the date they started trading for each accounting period thereafter, you would treat that partner like any other new unincorporated trade, using your normal bases of assessment, which were, of course, first year actual basis, start date through to the following 5th of April. The second tax year, do we have an accounting period ended? Now the chances are that not only will you have an accounting period ended in that second tax year, so far as the new partner is concerned, what you'll also have is the fact that it will be an accounting year, and therefore CYB would be available. The only other possibility that you might see in relation to this, you don't have all the possible outcomes as you do on a normal individual startup, but if it's not CYB, the only other possibility in that second tax year would be that you have an accounting period ended, but it's a short period, so far as that partner is concerned, because he joined part way through that period. And therefore, if you have a short period ended, remember, what's the basis of assessment in the second tax year? Well, there's a short period ended. Remember, a short period based on when that partner started to trade. The other partners, continuing partners, will have been a part of the partnership for the full year end concerned. They stay on CYB. But your new partner has the opening year rules. And the only other possibility, as I said, if it is a short period ended for that partner, then it's the first 12 months. What we now need to turn our attention to is what happens when one of our partners chooses to leave the partnership. Now, again, as we have said, any continuing partners will continue to be assessed using current year basis. As far as they're concerned, their business continues to trade. It is just the individual who leaves the partnership who will now be dealt with according to the rules for the years of cessation. And those rules were straightforward. Once you had determined the date of cessation, here the date when the partner leaves the partnership, either, again, using a retirement situation, as we'll see in a moment's time. What date is that? What is the tax year? That is the final tax year. Once you know the final tax year, go back to the penultimate tax year and assess it using CYB. Once you've done your CYB assessment for the penultimate tax year, then the assessment in the final tax year will include, well, I hope you remember, all remaining profits as yet unassessed. Now that again, depending on the accounting date and the cessation date chosen, that may be either one, maximum two accounting periods. Once you've got those profits or that profit, then it is reduced by any overlap profits from opening years, otherwise known as overlap relief there. It's a perfectly normal cessation so far as that partner is concerned. So let's have a little look therefore now at an example that will illustrate that. Now, if you go back to the example we've had running, we initially had partners A and V in partnership. Then we had partner FC join the partnership. Well, now, if we make a note of this, we'll now see that partner A, one of the original partners, partner A retired from the partnership on the 30th of September 2018. Now, if you look back to the previous example that we did, you saw that we came as far as the year ended December 17, where we established the CYB assessment that existed so far as partner A and indeed partner V were concerned. So here he's retired from the partnership on the 30th of September 18, from which date the two remaining partners, that of course being V and FC, very, very simple. They just divided profits equally. So no salaries, no interest on capital, and a profit sharing ratio of 1 to 1. You've already seen a number of times with the examples we've done how when you divide out an accounting period into however many months before the change, however many months after the change, that any salaries, any interest on capital would need to be time apportioned. You know how to do it. There's no need to bother with that here. So we're just dividing profits equally. The partnership tax adjusted trading profit for the accounting year ended December 18, remember the partnership prepares accounts to December year ends, that was £120,000. And what we need to know so far as partner A is concerned, as now it's a cessation, is what was the overlap profit. And the overlap profit from opening years, we are informed, was £8,000. Right, how do we deal with partner A here? V and FC will just be normal continuing partners, and therefore they will be assessed using CYB for the year ended December 18, which will be assessed in 18-19. It'll be a normal CYB assessment. We'll do the division of that profit in a moment's time. Partner A, who has retired, left the partnership on the 30th September 18. That, for our purposes, is the date that A ceased trading. That date is in the 18-19 tax year, so we now know his final tax year. But before we can do assessments for any of these tax years, we need to know how this profit of $120,000 for the year ended December 18 will be divided between the partners, given that on the 30th September 18, partner A left the partnership, and clearly at that point there was a change in the profit sharing agreement. So let's remind ourselves, therefore, of how we divide out our profits. And it should, of course, be simple enough so far as we're concerned. How do we do it? Well, we've got to deal with, over the full accounting period, three partners, A, V and FC. So we're going to need a total column, as ever, and a column for partner A, partner V and FC. Which accounting period are we dealing with? The year ended 31st of December 18. What tax adjusted trading profit do we have? As given, £120,000. We now need, of course, to divide that out into how much is to be divided on the old agreement prior to partner A leaving the partnership, and then how much on the new. Well, the change in the partnership occurred at the 30th of September 18. The accounting period is year ended December, so from the 1st of January 18 to the 30th of September 18. So we will take 9 months worth of our profit of £120,000, which of course, nice and easily divisible by 12, will be then £90,000. And how will that be divided? Well, what was the old agreement when we had A, V and FC? We had salaries, didn't we? But again, this is a 9-month period up to the date of change, so we take 9/12 of those salaries. What were the salary levels? Now, you may need to go back, if you haven't already got it open, and look at the example that we did in our previous session together, where after FC had joined the partnership, we had salaries of £20,000 per annum for each of A and V, and £10,000 per annum for FC. So we want 9/12 of those salaries. 9/12 of £20,000, £15,000, and that is true for both A and V. FC's annual salary was £10,000, 9/12 of that will be £7,500. So salaries credited here, 15 plus 15 plus 7.5 is £37,500. We had a profit sharing ratio of 3 to 2 to 1, and having got £90,000 for this period, we've allocated so far £37,500. That therefore will leave, we'll take 37.5 from 90, and that is what, £52,500. Calculators out as ever. PSR 3 to 2 to 1, 3 plus 2 plus 1 is 6, divide by 6, 52,500, divide by 6, and partner FC gets that one share, and that comes to £8,750, methinks. 2/6, 1/3 of that belongs to partner V, and that therefore, or 2 times 8, 750, is going to be, what's that, £17,500, and 3/6 of the 52,500, i.e. 26,250, will be credited to partner A here. So the first part of the accounting period, up to the date when partner A left the partnership, 9 months of 120, old agreement salaries, old agreement PSR. What therefore have we now got? We have got, for partner A, which is up to his date of cessation, of course, 15,000 plus 26,250, what's that, 41,250. Partner V, 15 plus 17, 32,500. And partner FC, 7.5 plus 8, 750 is 15, 16, 16,250. Crosscast, get your calculators out, make sure, as you do this in the exam, 16,250 plus 32,500 plus 41,250 hopefully comes to £90,000, and the first part of the accounting period is now sorted. We've dealt with the 3 partners up to the date when partner A left. Now that, of course, now just leaves the remaining 3 months, which was where our new agreement, 3/12 of 120, of course, £30,000 here. Now what do we have? Well, it was nice and simple, wasn't it? We got no salaries, we got no interest on capital. All we've got is a profit sharing ratio dividing equally those profits between them. What we know, of course, is that by this point in time A has left the partnership, so there's nothing for him, and the 30,000 being divided 1 to 1 will be a credit of 15,000 to V, and the same 15,000 to FC. What therefore does that give us? A hasn't changed, he's still got his 41,250. 15 on to 32,500 is what? 47,500 for partner V, and 15 plus 16,250 is, I think, there 31,250. Again, just cross-cast, we had in total for the accounting period £120,000 of tax-adjusted trading profit. That hopefully 41,251 and 47,88 and 21, 119. Yep, £120,000, but do check it through. Right, once and only once you have dealt with the accounting period and established these tax-adjusted trading profits for each partner, can you then deal with the assessments. Now again, if we just deal with the easy bit first, we know that partner V and FC are continuing partners, and that they therefore will be assessed using CYB, and we are dealing with, which accounting year end is it? It's the year ended 31st of December 18, which we know will be assessed in the 18-19 tax year. So in the 18-19 tax year, what is the share of the £120,000 profit assessed for that period divided between each of V and FC? What have we got? There we go. 47,500 for V, 31,250 for FC. CYB assessments for the 2018-19 tax year. But of course it is partner A that is the main focus of our attention here. He's the more awkward one because he's left the partnership. How do we deal with a cessation? look at the date of cessation, 30th of September 18, and as we said when we first reviewed the information, in what tax year does that date fall? It falls, of course, in the 2018-19 tax year. So that, therefore, is the final tax year. So the penultimate tax year would be 2017-18, where a CYB assessment would have applied, and that we've already dealt with. If again we go back to what we were looking at in our last session together, what we had, there we go, year ended 31st of December 17, assessed in 17-18, partner A, £45,000. That was the CYB assessment. That 45,000 is how much tax-adjusted trading profit was made by partner A in the year ended December 17, which, as we've said, using CYB, as you can see there, is the 2017-18 tax year. Job done. So, just to bring that into the exercise we're doing here, let me just scroll through. 2017-18 CYB assessment, as we said, that was based on the accounting year ended December 17, and I don't want to scroll back. I think, was it 45,000? I think it was that, but you can check back through. So we'd already done it. Right. CYB assessment in penultimate tax year. All remaining profit is then allocated to the final tax year, from which we will then deduct the overlap profit as our so-called overlap relief there. So, what is the remaining profit still to be assessed? We've gone as far as 31st of December of 17, so we've simply got what was for partner A, his or her final period through to the 30th of September 18. Whereas we have just seen, we have established a profit figure of £41,250. 41,250. We were told in the question about the overlap profits, so less overlap. You can write overlap profit or overlap relief. Now, what was that overlap profit? What did we note there? Was it £8,000, if I recall correctly? Let's just have another look at that, sorry. Yeah, the overlap profit for partner A was £8,000 there. There it is. Okay, take that away now, as you do in any year of cessation. Overlap relief, 8,000. And we derive what presumably is then 33,250 as the assessment for partner A for the 2018-19 tax year, which, as we've said, is the final tax year so far as partner A is concerned. So, when dealing with a partnership, from the very first tax year of trading to the very final tax year of trading, should there be any change in the profit sharing agreement of the partners, should there be a change in the partners, whether that be a new partner coming in and or an old partner going out, we know that whatever has happened during the accounting period, the first thing we do is to divide out the tax-adjusted trading profit between the partners using the agreement in force during that period. Once done, and only once done, can we then take each partner's individual figure of profit and, using the relevant basis of assessment for each partner, CYB for a normal continuing partner, opening year's rules for a new partner, and closing year rules for an old partner, one that leaves the partnership. That allows us to work every assessment for every partner for any tax year, for any situation that we might have to deal with. So no matter what's happening in the partnership, no matter how many partners, what the level of profits, you can now work out the assessment for each and every partner. It leaves us, therefore, with just one other issue to contend with. That is, what happens if you don't make a profit but the partnership makes a loss. Now that is relatively easily dealt with, I'm happy to say. because we don't have to do the computational part of this so far as our syllabus is concerned. What we need to do is, or what we need to be, is aware of what the rules are. Now, we still divide out our losses as we would our profits. Losses are allocated between partners in the same way as profits, i.e., what was the profit sharing agreement during the accounting period. Now, that exercise you won't have to do. You would be told what losses, if any, were made by the partners concerned. What we've got to be aware of is what loss reliefs are then available to those partners. Now, remember, we don't tax, we don't assess the partnership, therefore we don't give the partnership loss reliefs. We give each partner loss reliefs on their share of the tax-adjusted trading loss. So, each partner is free to make their own decision over the available loss to choose to use. They'll choose, of course, the one that is most beneficial for them, principally the one that gives them relief at the earliest opportunity and which will relieve profits that would be taxed at the highest rate, or income that would be taxed as the highest rate, whichever the case may be. So, as we note here, loss relief claims are available, same as for sole traders, same as we looked at in our previous chapter 7, and each partner may then choose their own preferred use of the loss. We do not all have to do the same thing, each partner free to make their own choice. So remember, if you've got a normal ongoing business, so continuing partners there in a partnership, then there were 3 possible claims, the very simplest of which is you just choose to claim to carry forward your trading loss to set off against, well, if you carry forward a loss, what does it set off against? Future trading profits of the same trade. So there's one option. But if the partner wants a more immediate relief, then they can choose to set off against total income of either the current and or the preceding tax years. And if for one of those years, whether it be the current or the preceding year, if they've made that claim and there is still loss left over, then for that tax year, the one in which the claim has been made against total income, then any balance, any remaining loss, subject to the maximum loss calculation that we saw, we could thereafter extend against chargeable gains. If, of course, you choose not to extend against gains, then you just carry forward the loss, as we mentioned a moment ago, against future trading profits of the same trade. But as we have seen, we may have a change in the partners, a new partner coming in and or an old partner going out. So in which case, as well as considering the available options of set off against total income of current tax year and or preceding tax year that would be available for any partner in relation to any tax year in which they have traded, we would also have, again as the current and preceding, the carry forward. The carry forward, of course, would not be a possibility for a partner leaving the partnership. If they have ceased to trade, then they have no future trading profits to carry forward to. But the partner joining or the partner leaving, remember, is viewed to be a new business startup for that individual or an old business cessation. And in opening and in closing years, we have those specialist loss reliefs. So a partner joining the partnership and then sustaining a loss may be able to choose to claim under the opening year's loss relief. Now remember, when did that apply to? If a trader sustains a loss in any of the first 4 tax years of trading. So for losses in the first 4 tax years of his membership of the partnership. That relief is not available to existing partners. This is only available if the partner concerned is within any of his or her first 4 tax years of assessment. Remember what it then allowed you to do? Carry back, but carry back further than the normal 1-year carry back period. we can go back against total income of the preceding 3 tax years. That specialist opening year's relief carry back against total income of the preceding 3 tax years. It's one single claim against all 3 of those tax years, so you tackle those tax years on a first in, first out basis. You go back 3 years, set off against total income. If there's more loss than total income, then the balance of loss goes against the total income of 2 years ago. And if the loss is still left over after that, then it goes against 1 year ago. So carry back against the preceding 3 tax years on a first in, first out basis, going to the oldest there, the earliest profits, the earliest tax year. A partner leaving a partnership, that's a cessation, and therefore, given that there is no carry forward, as we've already mentioned, you get to claim under terminal loss relief. Again, that is a loss available only for losses sustained in the last 12 months of trading. Having computed that loss, remember how we do it, dividing the last 12 months into how much of it fell into the penultimate tax year and how much fell into the final tax year. Once you have that loss computed, then it will go back against the trading profit of, so it's purely trading profit. We say of the final tax year, but that's going to be a loss, so it'll be a nil assessment anyway in 99.999% of occasions. So for us it effectively means we go back against the trading income of the preceding 3 tax years. Notice just trading income, not total income, of the preceding 3 tax years. This time on a LIFO basis. So if we cease trading in 1718, we go back against the trading income of 1617, followed by 1516, followed by 1415, if we had sufficient loss to go back that period. Now, you won't have to compute those losses, you merely have to know what reliefs are available. That is what I've just summarised a moment ago, and is basically tested here in example 3 to state the loss relief claims that will be available to the partners. We are told John, James and Paul are in partnership, making up their accounts to 5th of April. During 16, Paul left the partnership and George joined in his place. So during 1617, Paul left the partnership, George joined. So for who we're left with, Paul left the partnership, so we've got John and James there. They continue, so they will be assessed on CYB. They are continuing partners, and on that basis, therefore, those are the reliefs available. Paul left the partnership, it's a cessation, so in addition to the current year relief and the 1 year carry back relief, there is terminal loss relief. Remember, there's no carry forward because he ceased to trade. But we've got the specialised terminal loss. And George joined in his place. Well, we've got the set. You've got your current tax year, preceding tax year claims against total income. You've got your carry forward against future trading profit. Or if he wants to use that loss more quickly, which is often the way, then the specialist opening year's relief set off against the total income of the preceding 3 tax years. Clearly, of course, if any of the partners are making a claim against total income of current tax year or the preceding tax year, and having made the claim, there is still loss left over, then the possibility of the extension claim, of course, exists against capital gains. Now, that basically is a summary of what you need to be writing here. Make sure you're happy with how you would express those loss reliefs, and then check them out with the answer. Now, that, you'll be very relieved to hear, is not just the end of this particular chapter, but it's the end of some 5 chapters worth of work that have had to be undertaken to deal with how it is that unincorporated traders will be charged to taxation and how their losses, if made, will be relieved. We now have the opportunity to move to chapter 9, where we look at employment income. Employment income. which of course is probably the main source, if not only source of income for the majority of taxpayers. It's a very simple basis of assessment that I hope you remember from Chapter 2, simply actual amounts received. But what makes employment income as big a chapter as it is not simply dealing with the salary and wages of individuals, but in the range of benefits that might be provided to that employee by their employer. Recognising firstly which are exempt and which are taxable, and if they are taxable, how are they taxed? We have a problem there in determining how might you determine an annual benefit to put in relation to the use of a company car, for example. How will we do that? Well, as you may guess, it's not left up to us to decide what will be taxed. They have their own special rules. Another area that has to be looked at, but there's few and far between the examples of this, and that is if an individual employee incurs expenses, will those expenses be allowable against employment income? Well, there are some, but it's notoriously difficult to get expenses allowed against employment income. But all of that awaits us in Chapter 9. Again, as ever, we look forward to seeing you then.